What's going on, traders? What's going on, YouTubers? Welcome back to another live stream. Today, I'm going to give you 3 tips on how you can make money when the stock market's going down. Are these guarantees? Of course not. Never is anything really a guarantee, but these are going to be 3 extremely useful and helpful tips that all you traders should know to give you the extra edge in making money while the market's going down. Okay, so let's just say the market does fully correct, because right now is a crazy time period for the market. Let's say it does fully correct. Let's even say that it starts to crash like it kind of did in 08. Not kind of, but it did in 08. Let's just say. These are going to be 3 tips that you can use to make money trading the stock market while it's going down, and you can still be long biased. So if you're not familiar with short selling, you don't have the option to short sell, and you only know about buying stocks and making money as they go up, or ETFs, this is what we're going to show you and which ones to watch so that you too can make money if the markets are going down, but you can make it by actually buying the stocks to the long side, hoping they're going to go up. So I'm going to dive into this video here. We're going to go over the 3 tips real quick, and we're going to dive into it. So let's go ahead and start sharing the screen to you guys, so you can see exactly what it is I'm looking at. All right, so right now you should see 4 stock charts, right? So we have 4 different stock charts, and you'll come to find that the 2 on the left here that I'm zooming in on look identically the same. Right now, we're actually looking at these stock charts on a 180-day 4-hour time frame. So this chart is, zooming out at a view of 180 days over 4-hour time periods throughout the day, and this is what the charts look like. The one on the top here, so we got this one here is UVXY, and this ticker down here is TVIX. Okay. As you can see, both of these look exactly the same. This stock chart looks exactly the same as this one below. The only difference on these 2 stock charts is their price. And there's some other things, but we'll get to that. All right. So you see, they look identically the same. The only difference is the ticker name, the name of them, and their actual price. Okay. These particular 2 tickers, TVIX and UVXY, these 2 particular tickers, one of them is an ETF and the other is actually an ETN. Okay. Either way, these are 2 tickers that you can actively trade while the markets are going down to make a substantial profit. Okay. Now, what I'm going to get at here is that these particular tickers, they follow or they trade inversely to the overall market. Okay, so we'll look at this is the SPY, or you could look at the actual S&P, right? You could look at either one of these. It doesn't matter. They're basically the exact same, right? You have the SPX, the actual S&P 500, and then you have SPY, which is an ETF that is basically, it follows the same price action of the index, the S&P 500. With that being said, right, look at the market. We know that it crashed this day, it crashed throughout this week, then we tried to go higher, and then we crashed again. I want you to look at the dates, and this is where it gets a little important. Look at the date. So on this date, at the very high on the SPY or the S&P 500 here at 28 or 286 or 28,000, on 129, this was the day that everything kind of started going down, right? So on 129, let's just say even 2.5, right? This big day, 2.5. If you come over here to this chart on UVXY, or you come over to the stock chart on TVIX, you'll notice on the date 2.5. So let me mark it for you. So right here, right here on this day, 2.5. 2.5. 2.5. Do you notice anything? Well, on 2.5, that was the day that TVIX and UVXY had that really big push up. In one day, these 2 stock charts went up very big, 100% or something like that. This one, UVXY, went from about 15, 16 all the way to a high of 35. TVIX went from about lows of $6 to a high of 16, okay, in one day. And that was based off of the same day that the market started really coming down. Okay, so on 2.5, that's when the market really was coming down. 2.5, both UVXY and TVIX shot up very, very big. Shut up very, very big. So, right, you can see that when the markets are going down, these volatility funds, these volatility ETFs, they go up. They trade the opposite direction of the market. Okay? So if the markets do in fact start crashing, or the markets do start going down, you can expect that these ETFs will go up. Okay? Now, let me talk about something else. Just because, let's say that the market goes down, right? Just because the market's going down does not mean that this has to go up very fast, and does not mean that it has to go up a lot. These tickers, these two funds, and there's more than just these two that I'm showing you, and I'll do videos on those as well. But I'm showing you these two for now, and there's many else out there. If you'd like, you can search up ETFs that trade inversely of the overall market or the stock market. You'll find some on Investopedia. You'll find some on some other blog sites, QQQ, VXX. These are all similar ETFs that trade the opposite direction of the market, okay? They just all are a different ticker, and they might be priced a little differently. So when I said that, just because the market's going down doesn't mean that these have to shoot up very fast or go up a ton. What I'm saying is that TVIX and UVXY are ETFs comprised to trade opposite of the stock market, but they are determined by the volatility index, okay? So this down here, this screen down here on the right, this one, this is what we call the volatility index, the VIX, and I'm actually going to change this over. This is the volatility index, okay? So it's just a stock chart. These are just, don't get confused. These two over here are just ETFs that we can trade and buy every single day to make money. The stock chart up here in the upper right, this is just the stock market, right? This is just showing me the direction of the stock market. So let me map this out so nobody gets confused, right? So real fast. We'll do it like this. Oh, we'll use like, what do we use? We'll use green. Okay, so number one, oh, I'm on that. That doesn't work. So number one, this one over here, this is just an ETF that you can buy like a stock. All right. Down here, this is just an ETN. This is number two, right? This one you can just buy like a stock, right? Number three, here is the market. So I'm just making this so you don't get confused or I don't lose you guys, because I know it's a lot. It could be a lot of boring talk in between. So this is just the market, and then down here, number four is the volatility. All right, that's enough. You get it. We'll just go back and we'll just put the vol, right? That's volatility. Okay. So how does this work? And so in a whole, how does this work right here? What I'm showing you, how are we going to trade these ETFs when the market's going down to make money based on the volatility index? Okay. So I'm going to get crazy with it here. So stick with me, right? So you have just these two here on the left are just ETFs you can buy to make money. On the upper right, this is the stock market, just showing you the direction the market's going in. Number four down here on the right, this is VIX. You can type it in like a regular ticker. It's the volatility index. This is also known as the fear gauge right here in this bottom right. This is known as the fear gauge because this right here tracks volatility in the stock market. And the stock market usually becomes extremely, extremely volatile when the markets are correcting, when markets are crashing, when there's a bear market, when people are scared, that is when this volatility index will go through the roof. Okay, it will explode. When people are scared that markets are crashing, the volatility index will start going up. Okay, the volatility index right here, this one, right, this guy, the volatility index is what affects the price on these ETFs. Okay, so I'm going to show you this little motion on how it actually goes, right? So I'm going to clear everything off the chart. So this is how everything starts, right? We start here with the stock market. This is where we start. This is our starting point right here. When people start getting scared that the market's going to go down and we start seeing extremely volatile downward moves in the market, this scares people that this could be the stock market crashing or it could be correcting, which again, and it catapults that fear because we've had such a long bull run without really any serious correction. This is what's scaring people. This has also helped driving it down. When people think that the market is correcting, is crashing, people get scared. What does that do? What happens when people get scared is it ends up causing this guy, the volatility index. So we go from people being scared here, which causes selling pressure in the market to come down, which will then increase the volatility in the overall market. So you'll start seeing the VIX or the volatility index start to go up. That means people are getting really scared. They're starting to sell, which will then cause people to shift their portfolios, which will start to bring more interest into ETFs that trade the opposite direction of the stock market. So if the market's going down, more interest will then pull into these ETFs that trade up when the market's going down. So you have now these two tickers starting to see more interest because people are scared the market's going down. Okay. So when people are scared, right? So when people start getting scared here that the market's going to go down, you'll see an increase in the volatility index, which will then result into people starting to buy and trade the tickers like TVIX and UVXY. Okay. This here is a gauge. This volatility index is a gauge. So you can say that when the volatility index is high or higher, you can expect that tickers like UVXY and TVIX are going to make bigger moves. The more volatile the market is, the faster the market's dropping, the more selling pressure the market sees, the higher the volatility index is, which results in faster price movements and faster fluctuations on tickers like UVXY, TVIX, and QQQ and VXX. All the tickers that trade inversely of the market are first affected, have to have a lot of volatility, which will cause them to drive up the price very quickly or come down very quickly. All right, I'm going to take a second to zoom in here on a different time frame. So right now we're going to look at the volatility index. Let's do I don't really like that. Let's do a different time frame, like 90 days. That'll work. Okay, so let's look at this 90-day chart. So when the volatility index was all the way at 50, this was the same time period, right? This is exactly the same time period right here, where we have the markets coming down super strong, which causes a huge push in volatility, which caused a huge interest in buying pressure in the stocks UVXY and TVIX. Okay, but these two tickers would not have gone up that fast without the volatility being this high, and the volatility will never get that high unless you're seeing really, really extreme pullbacks in the stock market like you're seeing right here and right now. That's what's going to cause big pushes in volatility in the market, which will result in big pushes in price jumps in inverse related ETFs to the stock market. Okay, going a little further, okay, let's take a look at the volatility index on like a 10-year chart. We're gonna go, or actually I think I'm gonna go 15 years on this one. Let's go back extremely far to like a 15-year chart, right? And then I'm going to clear all these drawings first. I know this is a long video. Bear with me. It's all very useful. You guys are going to love me after it. This is how a lot of the members in Boiler Room Trading have been able to stay green throughout a lot of these bear markets, and we're still trading and holding some good positions because they know exactly what's going on because I've explained this to them already. Going a step further, let's look at the 10-year chart on the volatility index. We're going to go 15 years, sorry. A 15-year, and we'll go a weekly chart. 15 years, weekly time frame, right? So look at this. Right here, if I zoom in, you will see that this year in time was 2008, and the volatility index went all the way to a high of 89. Okay, let's zoom out now. Went all the way to a high of 89 when the markets started to crash. Okay, back in 2006, which is right here, this was the low of the volatility index. We just broke through that low from like 15 or sorry, for like 14 years ago or 12 years ago. We just broke through that low right now in the market. So that means volatility in the market was at its low when the stock market was all the way at 28,000. People were thinking the market's going to keep going up. It's going to keep driving. This force is going to keep going. So volatility was at an all-time low because people were so comfortable with where the market had been. We'd been going up for so long, right? Let me zoom out here, right? And look at a 3-year. The market had been going up so great for so long that people stopped getting scared and started becoming more comfortable, which caused a decrease in the volatility index, which then would cause a decrease in interest for tickers like UVXY, in TVIX, in VXX. But when the stock market did in fact start pulling back very aggressively, you can see there was an obnoxious spike in volatility, right? And then you can see there's an obnoxious spike in price action. Okay, let's take a step back further. So look at back here when in 2008 we went really high. We have hardly even started pulling back, and the volatility index is already reached half of that on one day, right? It doesn't mean that the volatility index is actually going to go above 89 or any of that stuff. It doesn't mean it's going to go to an all-time high or anything like that. All I'm saying is back in 2008, when the volatility index increased like that, that's when we were crashing. We are starting to see an interest again in the you can start seeing that there's a big volatility increase in the market right now. Okay, so that means that people are starting to think that, hey, this might be the market's correcting. What we're going to do is start, putting our money into ETFs and tickers like this, so that if in fact the market does come down, we have a little bit of protection. Okay. These two tickers will tend to decay over time though, okay? They do decay. So if there's not a lot of volatility, right? So if there's no volatility in the market, these will gradually go down. It's only when there's high volatility and when the markets are coming down that the prices on this will go up, okay? So remember that when the volatility is high, these will go up. But the only way you're going to see an increase in volatility is like this, when the markets are going down. So now that we've looked at everything from a long time frame, how about we zoom in to earlier or closer time frames to get a better idea? So let's do a 5-day chart on the volatility index, and then let's do a 5-day chart on the stock market, and then we'll do 5-day charts on both of these two tickers. Okay. Now that we've kind of zoomed into, real time, relevant, past couple days, let's see what happened, okay? Well, let's zoom in on this day. All right, we'll zoom in here. This is the day that the Feds released, talks about the trade war and tariffs and something like, or no, sorry, this was the Fed talk about higher interest rates, okay? So on this day, Which day was that? What day am I even on? I am on, that's Thursday, so okay. So it was this day right here, I believe. No, that doesn't make sense. Right. Yes. Okay, so this is it right here. This is where we need to focus, just these couple days. So you can see that when the market started going down, you can see that the volatility index starts to increase. So even the slightest bit of movement to the downside will start to usually bring in some volatility on the index. The VIX will start to increase. So as soon as this market starts coming down, people will start getting scared. Volatility will increase, and then you can see what happens to the price action of these ETFs. Right? These all follow, you can see, these are all the same patterns. The volatility index looks like the exact same pattern as these stock charts, and it's all opposite of the stock market. So the harder the market comes down, the more the volatility increases, the more the prices go up on these ETFs. These ETFs and the volatility index will all look the exact same, but they will look the exact opposite of the stock market. There are multiple different ETFs that follow inversely to the stock market and follow the volatility index, okay? You can find many of them. VXX and QQQ are just two of them off the top of my head you could look at, okay? With that being said, they're not going to be all the same prices, and some may move a little bit faster than others, but that's for another video, okay? So I'm going to go ahead and stop sharing the screen. If you guys have some questions, I would love to go over some of those right now for you and go from there. So again, if you guys have some questions you would like me to answer, anything that you would like me to go over, now would be the time to ask it. Yeah, so now would be the time to ask it before we head out, before we close out this live stream. So again, if you guys do have some questions, let's go ahead and do it. I'm gonna start going through some of the comments here. NASDAQ, I would have to do a little bit I would have to dig a little bit deeper into the materials aspect, to get a better understanding of it. So that's more of, a longer answer that I can't really wrap my head around right now. So I couldn't tell you, my man. So again, right now, if you guys have any questions, let me know. We can cover those here before we head out. But those two tickers, you guys can keep your eyes on while the market's kind of shaky right now, okay? I would highly suggest doing that because those two tickers will go up. If the markets come down, they will go up and they will provide a great opportunity for a long position. Just make sure that you watch the volatility index. Something I forgot to mention is the volatility index is at a high when it starts to get over when it starts to get over like 18, 20. After about 18 and the 20 mark on the volatility index, which is VIX, that's where I would start to consider the volatilities kind of a little high, where you'll actually start to see fast price movements on UVXY and TVIX. That's another thing that I want to touch real fast. When the volatility index is low, these ETFs will not make big moves. It's only when the market goes down hard, volatility will increase to high levels, and that's when you'll see significant price fluctuations on these inverse ETFs, okay? So the volatility index really has to be over like 20, 25 in that area to normally see some pretty significant moves. Honestly, over 15's okay, but you'd rather be in like 20s, 25s, 30s, as high as you can really get, because then you'll see huge price movements up and down. And that's where you'll make, a lot of money essentially trading them. Now, so that has that covered. So I'm glad we covered that before we head out there. Let's see, one second. I'm gonna go through some questions here. Have you done a video on how I can go in at market quickly in TOS? No, I haven't, because I don't really do my trading on TOS. I just mainly do it for charting. But again, as I do, all these things, I will dive more into TOS and get some more videos out there about some order execution. I might just, fund my Ameritrade account and start trading with them just to learn it better for the people that do use it. So that will probably be in the future. The SPY can keep dropping. Right now, the SPY has, based on pure technicals right now, the SPY has no reason to really start coming up. I mean, yeah, it kind of does, because we've had we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. We've had like 11, 10 days of just a red market without any green. So it's very possible we could start seeing a little bit of a bounce. But right now, the direction and trend is down. Yeah, so there you have it. That is everything I got for you today on this live stream. Stay tuned, because I will bring you some more information on the market here soon. Once again, to stay in touch with me and everything that is that Boiler Room Trading does, it is all in the description below of this video. We have some really cool features that we're going to start implementing into our trading room, something that I don't think is quite offered anywhere else. I don't know. Again, I don't know for sure, but we have some really, really cool features that we're going to be implementing here in the near future. Not right now, but the near future. So I'll keep you guys all posted on that news as it comes. So once again, thank you for tuning into my channel. If you like it, please like and subscribe and share the video to anybody you think this will be useful to. So once again, everybody take care.